this time. I just watched the Paul Tudor Jones video on the Invest Like the Best with Patrick O'Shaughnessy's podcast. And it was a wonderful interview. And I really recommend everybody listen to it. But I have one big criticism that I really wanted to share with you all. We have spoken about this on the channel before, but I wanted to say it more explicitly, given the fact that Paul Tudor Jones is, an important person. And until now, I've been very receptive to everything that he said in the past, mostly about monetary policy and inflation and stuff like that. But he mentioned something that I completely disagree with, which is he basically said the price to earnings ratio of the S&P is too expensive now. So his friend asked him, okay, if I had some money to invest in basically for 10 years or 20 years, where should I put it? And his friend expected him to say, just put it in the S&P 500 and forget about it. But instead, Paul Tudor Jones said, no, the expected return for times when the price to earnings was this high, 10 years going forward, is actually negative or whatever, very, very low. And so that's why he doesn't recommend that Paul Tudor Jones Paul Tudor Jones doesn't recommend to invest in the stock market right now. And it's curious to me that he mentions the price to earnings of the S&P because the nature of the companies that compose the S&P has been changing, right? So more and more tech companies have been entering the S&P, and they become a larger percentage of the index. And so that means that if you compare the price to earnings of the S&P today versus the price to earnings of the S&P, let's say 50 years ago, today the price to earnings will be much higher, but that doesn't necessarily mean that it's overvalued if more tech companies, where you basically invest in the future growth of the company versus something like a cement company, where you basically have a very predictable cash flow that's coming from houses being built and commercial, structures being built. And so a cement company will have a much lower price to earnings ratio than a tech company like a Tesla, which is basically because with cement, you can't see, the number of houses being built doing a 10x over the next 10 years. This can never happen. But with a company like Apple or Microsoft, the iPhone comes out, the personal computer comes out, you can definitely see a 10x in 10 years. And so that's why people are willing to pay a higher price to earnings ratio, because they're betting on the fact that this is a disruptive technology that will grow a lot faster than the average economy. And so as more and more of these companies are entering the S&P, then the price to earnings ratio of the S&P will just keep going up. But that doesn't mean it's overvalued. So if you claim that it's overvalued, I would compare the price to earnings of a similar basket of companies that currently has the S&P. So that's number one. So I don't see a higher price to earnings ratio as a sign of the market being overvalued, especially since tech is becoming such a larger and larger part of our lives. The second thing he said that I disagree with had basically to say about the IPOs that are coming. So you have SpaceX IPO and Claude, Anthropic, all of these guys. So it's going to be trillions of dollars in valuation of these IPOs. And Paul Tudor Jones says the money to buy these IPOs of SpaceX and Anthropic and all of these guys will come from other stocks, from other tech stocks. So that basically means that the index as a whole, like the stock market as a whole, will not benefit from these IPOs. And then the second thing he mentions is once the lockup for these IPOs ends in a year or two, then everybody's going to sell, and that's going to crash the stock market, which is what he claims that happened in 2001. After the dot-com IPOs of 2000. Now, first of all, in 2001, we had this 9/11 attack. So that was a complete exogenous shock. We had the Iraq war, the Afghanistan war, which was a crazy amount of spending money on things that don't create growth. And so I don't understand the comparison, especially given the fact that saying that this would come from other tech companies, that people who buy SpaceX and Anthropic on the IPO will do this by selling other tech companies. It's only bad for the index if those other tech companies are more valuable, right? If you sold something more valuable, then the overall index will perform worse. But what if Anthropic and Tesla, Tesla is talking about building humanoid robots that will basically replace a lot of the workforce. So, you IPO, sure, if you sell stocks of lower performing companies to buy higher performing companies, that is good for the index. So that's what I wanted to say. I don't see any problems with the index going forward. Of course, there might be blips. Of course, there might be crashes, but nothing structural going forward. And I definitely don't expect the next 10 years to not have good returns in the NASDAQ or the S&P for that matter, because of elevated price to earning ratios. So thank you all, and let me know what you think about these ideas.